Welcome to the Deep Dive. We're here to take a whole mountain of information, really distill it down, and give you clear, actionable insights. Today, we are plunging into the S&P 500 index. It's a complex world right now. Our mission is to unpack what our sources are calling a market of pretty profound contradictions. We want to help you understand the forces at play, the hidden risks, and, what it all means for you.
Absolutely. Yeah, we're going to break down this really fascinating analysis of the S&P 500, and it paints a picture that's frankly kind of contradictory. You've got these really strong bullish signals pushing things up,
Right.
but then also some seriously precarious situations sort of brewing underneath. We'll dig into that powerful AI narrative that's propelling so much of this, but also historically stretched valuations and some pretty formidable short-term headwinds. The goal is to help you grasp not just what's happening, but why it really matters right now.
Okay, so let's start with that big picture contradiction. Our sources describe the S&P 500 as being in a mature, sentiment-driven bull phase. What does that phrase sentiment-driven really mean here? And how much is it purely the AI narrative versus, fundamentals?
That's a great question because sentiment-driven here means the market's climb is relying heavily on investor belief, on optimism, maybe more so than just pure earnings growth driving it.
Right.
And the AI narrative, that whole transformative long-term story, it's definitely provided that powerful belief. This conviction has fueled what we call multiple expansion. Basically, investors are willing to pay a lot more for each dollar of future earnings,
Right.
especially from companies tied to AI. And the result, it's highly concentrated performance, a narrow group of mega caps doing most of the work.
And what's really interesting is how our sources highlight this simultaneous constraint. Like you have this powerful AI story, but also historically stretched valuations. What are the key headwinds making things so precarious?
Well, the biggest short-term headwinds really stem from a, let's say, fluid and unpredictable U.S. policy environment.
Tariffs.
Tariffs are a big one, yeah. And we're also navigating a pretty challenging macroeconomic backdrop generally. So
Right.
you've got this powerful long-term story pushing prices up, but equally powerful immediate challenges creating resistance. It's tense.
Yeah, it sounds like a really delicate balancing act. Our sources call it fragile optimism. You see momentum indicators screaming greed, but then there's significant institutional hedging, and retail investors are still pretty bearish. So this isn't just blind euphoria, is it?
No, not at all. It's much more nuanced than that. Market participants are definitely enjoying the rally,
Right.
but they're also actively preparing for potential volatility, hedging.
Right.
It's less about unbridled enthusiasm and more like a calculated dance, participating but keeping an eye on the exit.
Okay, so we've got the big picture contradictions. How does that actually play out in investor psychology? Let's peel back the layers on some of these sentiment indicators, like the VIX, the fear gauge. It's surprisingly low right now, isn't it? What's that telling us?
Yeah, the VIX is currently hovering, let's say, between 17 and 21. Now, to put that in context, that's down about 15% over the past month, and it's way below 30, which is usually the signal for acute market stress.
Okay.
So on the surface, yeah, it screams complacency. It suggests institutions aren't really pricing in major disruptions right now.
Okay, but here's where it gets really interesting, I thought. While the VIX is low, meaning hedging is relatively cheap, you look at retail trading forums, and our sources say there's palpable anxiety. People saying this should be 30 now, buying VIX calls. What's with that huge disconnect?
That schism is incredibly revealing. It's a core insight here. The VIX, it largely reflects institutional positioning, right? And they're not pricing in chaos. Retail sentiment, though, tends to be much more reactive. Headlines, immediate anxiety. So the implication is the current stability isn't necessarily risk-free. It's more of a calculated assessment by the professionals. And ironically, retail betting on a VIX spike by buying those call options, that activity itself might actually help keep volatility suppressed in the short term. It's kind of counterintuitive.
Huh. Okay. Now let's look at two other signals that seem completely opposite. The CNN Fear and Greed Index, that composite indicator, recently hit 56.54, firmly in greed. That's reflecting what the market is doing.
Exactly. That's the action. But then you contrast that with the AAII sentiment survey, the American Association of Individual Investors. That paints a very different picture. Retail bullish sentiment, only about 32.7% to 33.2%. That's below its historical average for like 17 of the last 18 weeks.
Wow.
And bearish sentiment is unusually high, 41.4%, way above its 31% historical average. This tells us what individual investors are thinking.
So putting those together, what's the main message? It sounds like the rally isn't really driven by Main Street conviction.
Exactly. The rally seems powered by large momentum following, institutional strategies, algorithms, and also passive index fund inflows, just money automatically going in.
Right.
That individual investor conviction, it's just not there. And our sources suggest it's likely due to those anxieties we talked about: inflation, tariffs, geopolitical stuff.
But from a contrarian view, doesn't high retail bearishness sometimes mean there's fuel for a rally, cash on the sidelines?
It absolutely can. That's one interpretation, definitely. If everyone's already bearish, maybe the selling pressure is exhausted. But conversely, it could also signal that this rally is genuinely fragile, like really vulnerable if that main AI story stumbles. Which way it cuts is key.
Okay, and the options market gives us another layer. The total put-call ratio is neutral, around 0.90. But the SPX put-call ratio, just for the S&P 500 index itself, is much higher at 1.24. What's that specific difference telling us?
Yeah, that discrepancy is a classic signal. It points towards institutional behavior. See, retail investors often use call options for, speculation, betting on upside.
Right.
But the SPX options market, that's primarily where the big institutions buy their portfolio insurance. Index put options.
Okay, hedging their bets.
Exactly. So that higher 1.24 ratio for the S&P index itself, it points to a professional investment community that's, well, cautiously bullish. They're participating, sure, but they're actively managing some substantial underlying risks, valuation, policy. They're clearly hedging, not all in.
Okay, so we've decoded the psychology, the sentiment. It's definitely mixed. But how healthy is this rally under the surface? Is it broad or just those few big names carrying the load? Let's look under the hood at market breadth.
Right. And when we look at breadth, the picture gets quite concerning, actually. The advanced decline line, the AD line, normally in a healthy rally, it confirms the trend, more stocks rising than falling. But right now, it's showing a clear bearish divergence. The S&P 500 index hits new highs, but the AD line is trending down. It means on many days, more stocks are actually falling than rising. That's a textbook sign of a rally lacking broad participation.
And we see similar divergences with stocks above their moving averages, don't we?
Yeah.
Like short-term versus long-term.
We do. About 66% of S&P 500 stocks are above their 50-day moving average. That shows, moderate short-term participation.
Okay.
However, only about 52% are trading above their long-term 200-day moving average.
Okay. Big difference.
That gap is critical. It tells us, the market has short-term momentum, but the long-term health of the average stock, it's actually quite weak. It's not a robust, broad advance.
And the trend in new 52-week highs, our sources called it subdued.
Exactly. So the collective message from all these breadth indicators, it's pretty unambiguous. The S&P 500's rally is narrow, it's unhealthy, and frankly, it looks fragile. The headline number you see is masking underlying weakness. The average stock isn't really playing along,
Right.
which makes the whole market highly vulnerable if those few mega cap leaders start to falter. It's like a Jenga tower, maybe?
Yeah, exactly. Okay, well, if the market's that narrow, let's talk price, the valuation. By almost any historical measure, our sources say the S&P 500 looks expensive. How expensive are we talking? What are the key metrics?
Yeah, when we dig into valuations, it's pretty clear the market is richly priced. The forward PE ratio, what investors are paying for next year's expected earnings, it's up around 21.6 to 22.2 times.
Okay.
That's significantly elevated compared to the long-term average, which is closer to like 16.8x. And this jump happened because the index price went up almost 15% since August, while earnings estimates only rose about 1.9%.
So it's a price running away from earnings.
Exactly. Clear sign of multiple expansion. People are paying more for each dollar of future earnings.
And looking backward,
Yeah.
the trailing 12-month PE.
Even higher, around 28.0x, compared to a historical average way back to the 1870s of maybe 16.0x. Yeah, it's up there. Indicates a very richly valued market relative to actual past profits. And it's price-driven, not because earnings suddenly crashed or anything, but the one that really stands out, I think, is the Shiller-Cape-E ratio, cyclically adjusted price to earning.
Right, that smooth things out over 10 years.
Exactly. Smooths out business cycles, gives a clearer long-term picture, and right now it's at a lofty 36.1x.
36.1. That's more than double the 20th century average of around 15x. Our sources point out CPE above 25x has only happened, 3 times since 1881, around 1929, 1999, and 2007. Each of those,
Yeah.
well, they heralded major market declines. That feels like a pretty strong warning sign, doesn't it?
It absolutely is. Now, CPE isn't a short-term timing tool. You can't trade off it tomorrow.
Right.
But its current level, it sends a powerful cautionary signal, especially for long-term investors. It really suggests the market is priced for, well, perfection and highly vulnerable to any kind of negative shock. Very little room for error baked in.
Okay, so with all these contradictions, high valuations, what happens next? Wall Street analysts seem all over the map. Year-end 2025 targets range from LPL's 5,650, 5,800, all the way up to Oppenheimer's bullish 7,100. What's driving such different views? And what's the main takeaway from that wide range?
Yeah, that dispersion is telling, isn't it? The critical takeaway, according to our sources, is what they call the tariff asterisk. It implicitly or explicitly accompanies basically every single forecast out there right now. Any revisions analysts make, they're almost entirely a function of what they assume is going to happen with U.S. tariffs. The S&P 500 is just hypersensitive to that one variable right now.
Okay. And our sources map out 3 potential scenarios for the next 12 months. Let's start with the base case. What's the probability there?
The base case gets a 50% probability. This assumes a soft landing for the economy. Think modest GDP growth, maybe 1.0, 1.5%. Tariffs stabilize around, say, 15%, and the Fed manages to cut rates once or twice. In that world, S&P 500 earnings growth holds up okay, around 9%, and the index ends the year somewhere in the 5,800 to 6,100 range. Plausible.
Then there's the more optimistic bull case, 25% probability. What's that look like?
The bull case imagines a comprehensive trade war de-escalation, tariffs come way down. Combine that with AI benefits really starting to spread more broadly and quickly. That could push 2026 earnings per share estimates up to $280 or even higher.
Wow.
In that scenario, the S&P 500 could potentially reach 6,400, maybe 6,500.
And finally, the bear case, also 25% probability. This sounds like the one keeping people up at night.
It certainly is. The bear case sees the trade war re-escalating significantly. That triggers a second wave of inflation. Core PCE, the Fed's preferred gauge, heads towards 3.5%, maybe 4.0%. The Fed is then forced to hold rates higher, maybe even start hiking again. That likely leads to a recession late 2025 or early 2026. S&P earnings estimates get slashed, and the index, well, it could retest the April lows around 4,800 or fall towards 5,200, maybe even lower. That's the ugly one.
Okay. Beyond just the numbers, markets are always driven by powerful stories, by narratives. What are the dominant ones shaping things right now?
Well, the single most powerful theme, no question, is the AI megaforce. The bull case sees AI as a truly general-purpose technology like electricity or the internet, unlocking massive productivity gains.
Right.
This fuels huge capital spending cycles. We're talking over $1 trillion just from hyperscalers like Microsoft, Amazon, Google between 2024 and 2027. And that spending massively benefits the picks and shovels companies, like NVIDIA providing the core tech.
But the bear narrative sees something different, maybe a speculative bubble, especially with those magnificent 7 stocks dominating everything. How risky is that concentration?
Yeah, this is a critical point the bears raise. The S&P 500's performance is dangerously concentrated in just those few names. They make up nearly 35% of the index's total market cap, and they've been responsible for over 70% of its returns since early 2023. Their valuations are extreme. NVIDIA's PE over 46x. Some discounted cash flow models suggest Microsoft might be significantly overvalued. This concentration creates profound contagion risk. If just 1 or 2 trigger events happen,
Like what?
like a major earnings miss from a bellwether like NVIDIA, or maybe a big regulatory crackdown, it could spark a sharp correlated sell-off. And because these stocks are so huge, their sell-off wouldn't just be contained, it would be a systemic market event.
Okay, another huge narrative, the policy gauntlet. Navigating tariffs. We're seeing the average U.S. tariff rate hit levels not seen since the 1930s. What's the direct hit to profits?
Analysts have tried to quantify this. A sustained high tariff environment. It acts as a direct drag on corporate profits. It could lower 2025 S&P 500 EPS forecasts down to maybe the 255 range.
Right.
And the market right now seems to be pricing in de-escalation, assuming tariffs won't get worse, maybe even get better. That makes the market highly vulnerable if we actually see a re-escalation shock. If tariffs go up, that baseline assumption breaks.
And that ties directly into the Federal Reserve's stagflationary tightrope, right? How do tariffs put the Fed in such a bind?
Exactly. Tariffs are inherently inflationary. They're a supply shock, make imports pricier, but they can also slow economic growth.
Right, stagflation risk.
Precisely. Slowing growth with rising inflation. That forces the Fed onto this really difficult tightrope. The market expects rate cuts, but Fed officials keep citing tariff uncertainty as a key reason to hold off on easing policy.
Makes sense.
Now, if tariffs do lead to that persistent second wave of inflation, BNP Paribas modeled it peaking near 4% in 2026. The Fed could be forced to get hawkish again, holding rates steady, maybe even hiking. That's a significant black swan risk, low probability maybe, but huge impact. It would trigger a severe derating of PE multiples across the board.
And finally, there are the geopolitical flashpoints. Low probability maybe, but high impact tail risks. What are the key ones people are watching?
Yeah, these are the things you hope don't happen but need to be aware of. Things like a serious escalation in the Russia-Ukraine war, or a direct conflict in the South China Sea involving China and Taiwan,
Wow.
or maybe a renewed, broader conflict in the Middle East that disrupts global energy supplies. Each has unique implications. A Chinese blockade of Taiwan, for example, that would just shatter market confidence. Massive supply chain disruptions across tech, manufacturing, everything. These are risks that, demand constant monitoring, even if they feel distant.
Okay, let's bring this down to the sector level for listeners. We know the S&P 500's performance is dominated by tech and those magnificent seven. But is that group still trading as one block, or are we seeing some cracks appear?
That's a great question, and our sources confirm. It's absolutely not a monolithic trade anymore. Companies with really clear AI monetization paths. NVIDIA, PE over 46x, Microsoft, almost every analyst rates it a buy. They're still getting rewarded richly. But others in that group, Apple, for instance, is facing headwinds. Tariff risks alone could hit them for $900 million in a single quarter, based on projections. And Tesla, clearly the laggard. PE over 142x, analysts deeply divided, 18 sell ratings.
Wow. Okay, so that divergence means the AI theme is maturing. You can't just buy the basket anymore. You need to be more selective.
Precisely. You got to pick your spots now. It requires a more active stock pickers approach within tech itself. And beyond tech, healthcare is emerging as a pretty compelling strategic overweight, according to some sources.
Why healthcare?
Well, it's trading at its deepest valuation discount to the broader S&P 500 in nearly 40 years, mostly due to policy uncertainty, things like drug pricing fears.
Right.
But it offers defensive characteristics, plus powerful long-term tailwinds, aging population, AI innovation within medicine. It's an interesting setup.
And financials. They seem to have been quietly doing pretty well.
Yeah, financials have shown notable resilience, actually outperforming the broader market recently. Valuations still look pretty attractive, and the banking system is generally on much firmer footing than, say, 15 years ago. It's a key potential beneficiary if we see that market broadening trend, where leadership moves beyond just tech. If the economy holds up, banks tend to do well.
Okay. And for hedging against inflation or geopolitical risks, what tactical sector moves make sense?
For those specific risks, tactical allocations to sectors with pricing power are prudent. Think energy and consumer staples.
How so?
Well, energy directly hedges against rising commodity prices, which often happens during inflation or conflict.
Right.
And consumer staples, think food, beverages, household goods. They provide defensive, non-cyclical demand. People still need to buy toothpaste and cereal, pretty much regardless of the macro environment.
Makes sense. Okay, so let's pull this all together. What does this mean for you, the listener, trying to navigate this complex market? Our deep dive suggests the S&P 500 is, well, fully valued, may be vulnerable, and definitely demands a sophisticated, active approach. What are the key takeaways for core portfolio strategy?
Yeah, for your core portfolio, it's certainly not a passive set it and forget it kind of environment right now. You probably want to maintain a strategic allocation to U.S. equities, but be prepared to actively rebalance.
Maybe.
Meaning trim some of those highly appreciated, super concentrated holdings, and maybe reallocate towards areas that look more undervalued. Also, it's probably wise to temper your long-term return expectations, that Shiller-KP ratio we talked about. It suggests forward 10-year returns for the S&P 500 are likely to be, well, below historical averages, significantly perhaps.
Yeah.
And finally, maybe enhance geographic diversification. Look overseas. Many international markets offer more attractive valuations right now and different cyclical drivers than the U.S.
Okay, and for tactical positioning, what kind of approach should listeners consider right now?
Some sources suggest a barbell approach. What does that mean? It means overweighting something defensive, like healthcare as a core holding, like we discussed, good valuation, defensive qualities.
Right.
But on the other side of the barbell, maintain selective technology exposure. Don't just ditch tech, but focus on companies with clear paths to monetization, maybe more reasonable valuations. Look beyond just the absolute megacaps. Maybe find that next tier of AI enablers that are less hyped but still have solid fundamentals.
And what about protecting against that potential inflation resurgence we discussed? Tariffs and all that.
Absolutely crucial. Establish some tactical allocations to inflation hedges that could include energy, consumer staples, like we mentioned, maybe commodities directly, or Treasury inflation-protected securities, TIPS.
TPS, right. Those adjust with inflation.
Exactly. They provide direct protection against rising prices. Given the real risk of a second inflation wave driven by tariffs, having some protection seems prudent.
And finally, active risk management. Seems absolutely key here. What are some practical steps people can take?
Yeah, risk management is paramount. First, maybe utilize options for portfolio hedging. With the VIX relatively low, S&P 500 put options, which protect against a market fall, are actually attractively priced right now. It's cheaper insurance than usual.
Okay.
Second, consider maintaining higher than normal cash levels. Don't think of cash as just doing nothing. Think of it as a strategic asset. It dampens volatility in your portfolio, and it gives you dry powder, ready cash to deploy if the market gives you better opportunities after a downturn.
Good point.
And finally, keep an eye on key technical levels, like the 200-day moving average for the S&P 500. A sustained break below that widely watched level, that would be a significant bearish technical signal. It would likely warrant adopting a more defensive portfolio posture overall.
Okay, so today we've taken a really deep dive into the S&P 500. We've uncovered a market defined by these fascinating contradictions. You've got the immense power of the AI narrative pushing things up, but then the fragility of narrow leadership, those stretched valuations, and really unpredictable policy headwinds.
Yeah, it's definitely a market that demands more than just awareness. It requires a nuanced, active, and adaptable approach to really navigate the complexities and prepare for both the opportunities and the risks that are clearly ahead.
So as you reflect on all this, here's something to consider. If the market truly is, as some say, priced for perfection, mainly on the back of AI and specific policy assumptions, what truly unforeseen long-term technological disruption, or maybe a global policy shift, something completely separate from the scenarios we've explored today, what could fundamentally alter your perspective on the S&P 500's future? We encourage you to keep exploring, keep questioning, and keep learning.